Okay, let's unpack this because honestly, it feels completely contradictory.
Right, it really does.
Yeah, I mean, you look at the state of the world right now, and oil is sitting at over $100 a barrel. The Middle East is facing, well, a major sustained conflict with this ongoing situation between the U.S. and Iran.
Yeah, it's intense.
And supply chains are heavily stressed again. Like if you read the macroeconomic forecasts, we were dealing with a level of global instability that usually signals a massive retreat from risk.
Absolutely, a total flight to safety.
Right. If this were a textbook, the stock market would be in a free fall right now.
Yeah.
But instead, you open your portfolio today, and you are likely looking at just a sea of green.
Yeah, record highs.
Exactly. The market is acting like a rocket ship. It's like it's completely ignoring the reality of the geopolitical landscape. How is it possible that our investment accounts are entirely green while the world, frankly, feels like a mess?
Well, it's what analysts are calling the big paradox of 2026. And it's a great question. We're looking at a market that appears entirely detached from those scary macroeconomic headlines.
Right.
But when you actually examine the stack of analysis and the underlying data you shared with us for this deep dive, you start to see that the detachment isn't a glitch.
It's not just blind optimism.
No, not at all. It's a highly specific structural mechanism. To really understand this paradox, we have to separate the geopolitical headlines from the underlying financial machinery.
Okay, so investors aren't just ignoring the risk.
Exactly. They are pricing in a totally different set of fundamentals that are, at this specific moment, overpowering the geopolitical noise.
Well, we're going to break down exactly how that machinery works today. The mission here is to sort of map out the architecture of this paradox so that you, the listener, can look at those bleak news headlines and your record high investment accounts and actually make sense of it.
Yeah, to understand the structural logic disconnecting the two.
Right. And to solve that paradox, we really have to first look at where the smart money is actually flowing. We have to establish that these market highs aren't just built on thin air. Right.
Correct. There is a massive structural shift happening in technology.
Yeah, and the sources point overwhelmingly to one thing acting as the bedrock for this market high, and it revolves around CapEx, capital expenditure.
Right, and we are seeing CapEx deployment on a scale that honestly defies traditional tech cycles.
It's massive.
Huge. We aren't just talking about standard hardware refreshes or, incremental software upgrades. Mega cap tech companies are spending billions, literally reallocating billions of dollars, specifically to front-run AI compute scarcity.
So they're buying up all the data center space they can get their hands on.
Exactly. The analysis emphasizes that we have moved past the initial hype cycle. The era of just dreaming about large language models.
Right, the whole look what this chatbot can do phase.
Yeah, we're past that. What's fascinating here is that the market is no longer pricing in the mere promise of artificial intelligence. It is actively pricing in the physical infrastructure required to sustain it, which means real profit.
Real profits, right.
We're looking at a historic build-out of data centers, the procurement of specialized silicon, and the securing of massive power contracts. It's a true productivity revolution.
Here's where it gets really interesting to me, is this massive CapEx spending, kind of like a popular restaurant that has talked about a new menu for years, but is finally spending the big bucks to install the expensive commercial ovens.
Oh, that's a really good way to look at it.
Like they've been hyping up the recipes forever, but now they're finally putting the money down to actually bake the goods.
Yes, exactly. They are buying the ovens, and the market is rewarding them because they are showing actual, measurable efficiency improvements, not just speculative promises. Companies utilizing these new AI architectures are flattening their middle management layers, they're automating complex customer resolution pipelines, and drastically reducing the time to market for software.
So they're structurally lowering their long-term operational costs.
Exactly. The market is looking at that operational leverage and calculating that the efficiency gains far outweigh the initial billions spent on the CapEx, or, the ovens in your analogy.
But okay, building that digital infrastructure, running those commercial ovens requires vast amounts of physical resources. Data centers don't just run on air.
Right. They need power. A lot of it.
An immense amount of power, advanced cooling systems, massive logistical supply chains, which is what makes it incredibly baffling when you look at the external pressures right now.
You mean the commodity markets?
Yes. Because, as we said, oil is sitting north of $100 a barrel due to the U.S.-Iran conflict. And normally, historically, energy spikes like that act as a massive tax on the entire global economy.
Oh, absolutely. It drives up the cost of manufacturing, shipping, power generation.
Right. A $100 barrel of oil normally crushes profit margins.
Yeah.
It halts a market rally dead in its tracks. So how are we not seeing that drag the market back down?
Well, the historical precedent is certainly there. I mean, if you look at the 1970s, an oil shock devastated the market.
Because everything was so physical back then, right?
Exactly. The S&P 500 was heavily dominated by industrial manufacturing, automotive companies, physical retail. The global economy was tethered directly to the cost of freight and heavy machinery.
But today is different.
Very different. The companies driving the current indices are predominantly software, services, and digital infrastructure. So megacap tech has largely decoupled its primary revenue streams from the physical supply chain.
They don't need a fleet of diesel trucks to ship a software update.
Precisely. Now, if we connect this to the bigger picture, it explains a concept the sources highlight, which is corporate earnings being incredibly resilient.
They called it a rubber ball resilience.
Yes, the rubber ball analogy. Earnings are bouncing back despite the heavy pressure.
But wait, let me jump in here. If oil is at $100, your immediate thought as a consumer is inflation. I mean, even if Microsoft or Google aren't directly paying for diesel fleets, the consumer absolutely is.
Sure, they're paying it at the pump.
Right. They're paying it at the pump at the grocery store.
Mm-hmm.
And high energy costs historically crush consumer discretionary spending. So how are these tech giants absorbing that macroeconomic hit without it, crushing demand?
Well, investors are looking past the noise of war because companies are actively finding new ways to stay profitable. The analysis introduces the concept of a bifurcated economy to explain this.
Okay, bifurcated how?
You are correct that the consumer is feeling the pressure of $100 oil. However, the companies driving this market rally possess an unprecedented level of pricing power.
Because their products aren't optional anymore.
Exactly. Their services, cloud computing, enterprise software, digital advertising, these are no longer discretionary spending for other businesses. They are mission-critical utility costs.
Like keeping the lights on.
Right. If a mid-size enterprise is facing margin pressure from inflation, they don't cut their cloud hosting or their AI analytics tools because those are the exact tools keeping them efficient. They cut physical real estate or headcount.
Wow. Okay, so what does this all mean? Are investors just wearing blinders? I mean, is it dangerous to categorize a major global conflict in $100 oil merely as noise? Or is this just the cold, hard reality of how corporate resilience is calculated?
It's the cold, hard reality. Financial markets are unsentimental pricing mechanisms. They do not price in morality, and they do not price in generalized macro anxiety unless that anxiety threatens future cash flows.
Which right now it isn't.
Exactly. The market is prioritizing corporate strength over geopolitical fear. Plus, it's not just the software margins insulating these companies. The sources highlight a massive financial buffer operating behind the scenes.
Oh, the debt structuring.
Yes, this is a critical mechanism that the broader headlines often completely miss. Back in 2020 and 2021, when interest rates were sitting at historic lows—
Near zero, basically.
Right, near zero. The largest corporations in the world engaged in a massive wave of debt refinancing. They locked in long-term corporate bonds at 2 or 3%.
Which is wild to think about now.
It is. They essentially immunized their balance sheets against future inflation and rising borrowing costs. So now, in 2026, while global energy prices are spiking, these mega-cap companies are not heavily exposed.
So they're sitting on piles of cash, earning 5% in money markets, while servicing long-term debt they locked in at 2%.
Exactly. They are actually generating net interest income while the rest of the economy deals with a credit squeeze.
That completely shifts how we have to view their vulnerability to the U.S.-Iran conflict, or really any energy shock. The market isn't wearing blinders, it's looking at the math. And the math says these specific companies have a structural fortress around their cash flow.
Yep. The earnings bounce back like a rubber ball because their debt is cheap, their margins are wide, and their products are indispensable.
Okay, that makes sense. That explains the steady floor into the market. It explains why $100 oil hasn't triggered a huge sell-off.
Right.
But, and this is a big but, logic and resilient earnings only give you a steady climb. We are talking about a market that is acting like a rocket ship. It's breaking record highs on a weekly basis. Fundamentals alone don't create parabolic charts.
No, they don't.
That requires emotional fuel. Human emotion acts as the fuel here, right?
It absolutely does. And that brings us to the final ingredient: Psychology. The sources identify this as the third major driver of the paradox. We are looking at a profound systemic wave of FOMO.
The fear of missing out.
Exactly. The fear of missing out on even higher gains. The S&P 500 continuously hitting new records creates a very specific, volatile psychological feedback loop.
So people are just jumping in because they see the numbers go up.
Pretty much. It forces capital into the market regardless of fundamental valuation. This raises an important question. Are we looking at smart technological growth or basic irrational human behavior?
It's a mix of both, right? I mean, you open your brokerage app, you see the indices pushing higher, and all that calculating logic about debt structuring we just talked about goes right out the window. It becomes a visceral reaction.
Right, but it's important to note this isn't just retail investors panic buying because their neighbor made money on a tech stock.
Oh, right. It's institutional, too.
Very much so. The sources point out that this FOMO is institutionalized. It is deeply embedded in how professional money managers are forced to operate. Institutional career risk is a massive accelerant here.
Explain that a bit more. How does career risk play into this?
Well, imagine you are a portfolio manager running a multi-billion-dollar fund. Your entire career, your compensation, your ability to attract clients, all of it is benchmarked against the performance of the S&P 500.
Okay.
If the market is rocketing upward, driven by AI infrastructure stocks, and you decided to sit in cash because you were worried about the geopolitical conflict...
You're drastically underperforming your benchmark. You look like a fool while everyone else is making money.
Exactly. Clients will pull their capital from your fund. So you are essentially forced to buy into the rally, even if you personally think the market is overvalued, simply to track the index.
Wow. So it creates a self-fulfilling prophecy. The higher the market goes, the more institutional money is forced off the sidelines and into these specific tech equities just to avoid career suicide.
Yep. Add to that the mechanics of algorithmic momentum trading.
Oh, the trading bots.
Right. A significant portion of daily market volume is driven by quantitative strategies that buy based on trend velocity. When the market breaks a new all-time high, these algorithms automatically trigger buy orders.
Which pushes the price even higher.
Exactly, which triggers more algorithms, which eventually forces the cautious human fund managers to capitulate and buy in.
You know, it's a fascinating irony when you step back and look at the total picture.
How so?
Well, despite all the billions spent on data centers and high-level corporate maneuvering, it's ironically comforting that the highest levels of global finance still heavily rely on people just acting like humans.
Yeah, that is true.
I mean, we have the smartest engineering minds on the planet, spending hundreds of billions of dollars to build the most advanced artificial intelligence in human history. We have CFOs executing brilliant macroeconomic maneuvering to lock in cheap debt.
The foundation is incredibly sophisticated.
Right. But the actual velocity of this rocket ship, the sheer upward violence of the rally, is ultimately powered by basic fear and greed. It's driven by algorithmic momentum and fund managers sweating over their quarterly performance reviews.
The machinery is highly advanced, but the fuel is entirely human. And that human element is precisely why the dynamic is so fragile. FOMO accelerates gains by pulling future returns forward.
It means the market is pricing in perfection.
Exactly. If a company is priced based on the expectation of flawless execution in its AI rollout, any slight deviation from that trajectory can trigger a massive recalibration.
Because that psychological feedback loop operates in both directions.
Right. Right now, it's a virtuous cycle of panic buying upward, but it can reverse just as fast.
So if we distill this deep dive down for everyone listening, the big paradox of 2026 is basically driven by three pillars holding each other up.
Yes. Three distinct pillars.
First, we have the AI reality, the massive CapEx deployment, buying the commercial ovens, so to speak, laying the physical infrastructure for a genuine, profitable productivity revolution.
Right.
Second, you have the corporate resilience, the market treating a major conflict and $100 oil as just noise because corporate balance sheets have that rubber ball elasticity thanks to cheap debt and pricing power.
Exactly. And third, you have the FOMO factor.
Right. Human emotion pouring gasoline on the fire as the S&P 500 hits new records. Both retail and institutional managers are basically forced to chase the rally.
And understanding the interaction between those three mechanisms is so valuable. It provides the clarity you need to navigate this environment.
So the next time you, the listener, look at your green portfolio while reading really bleak news headlines, you aren't just reacting to the disconnect. You'll actually understand the exact mechanics driving it.
You'll know you aren't looking at a market in denial. You are looking at a market actively weighing the cash flow protection of digital infrastructure against the inflationary drag of physical conflict, and deciding that the digital infrastructure is the heavier weight.
It gives you a much better lens to look through. But as we wrap up this deep dive into your sources, there was a final critical thought I want to leave you with to mull over on your own.
Yeah, the big unknown.
Right. Because we've established that this record-high market is based on a very specific, delicate balance of AI productivity, corporate resilience to high oil prices, and human FOMO.
A very fragile equilibrium.
Exactly. So what happens when that psychological FOMO suddenly flips into a fear of losing? What will be the specific tipping point that finally forces the market to stop treating global conflict as mere noise?
Is it a specific price per barrel of oil? A breaking point in the debt structure?
Right. Because if that rubber ball gets pushed just a millimeter past its breaking point, the noise instantly becomes the only thing the market can hear. Something to think about. Thanks for joining us on this deep dive.